everyone's time and get us hopefully out of here by 10 o'clock. As you noticed, Catherine Rich just turned on the recording for this meeting. Since we are a board committee, we do record our meetings and they are public, open to the public. So that does happen every meeting. We have two new committee members I'd like to welcome aboard this meeting. We have Missy Dirks from our FCTA. She's our FCTA representative. She's also FCTA's president. And we have Megan Quinn. Megan is our representative from our HR department. So we welcome you guys aboard. We have with us our new consultants with us from Siegel. We have Tanya Keaty and Joey Mallon. Did I say that right, Joey?
That's right. Thank you.
So they're with us. Christian is out on vacation, as he noted at the last meeting. So these two will be taking us through our journey and going through the agenda. As I noted in the agenda, we've got the approval of the minutes, which is an action item. We're going to have the analysis of the investment performance, which Tanya is going to go over with us. That's information only. We welcome questions. We have our draft investment policy statement. I'll ask for consensus on that to go to our board and get approval. And then we're going to have an education session on private credit asset class. This is an education session. I'm not asking for decisions. We're going to just get educated as a committee member of where we want to go. I have also asked Siegel to separately schedule a time for our new members to go through fiduciary training. But they've also offered to train on just a basic investments 101, kind of what stocks, what's bond, how does it work, and another investment 201 class, so any of us can join in on these sessions. So we're looking, I think Christian and I were talking yesterday, sometime in October for that. So we will throw out some dates and times that work and get those trainings done to give everybody a little bit more information and baseline as what is your role as a committee member and, you know, what you should be thinking about as you're making these decisions and talking about these different various topics that we discuss on investments. I am going to ask if y'all don't mind just to go around, since we do have some new members with the two new Siegel reps, our two new committee members, for everyone to introduce themselves, who they are, you know, who do they represent? Because we do have 9 different members on the board and on the committee. So I just want everyone to know who they are. So I'm going to call out, but just by my screen and who's where on my screen. So if you don't mind introducing yourself. Brian, I'm going to start with you.
Sorry, couldn't get off mute. I'm Brian Ropp. I represent the community, and my profession is I'm a managing director at Kroll Bond Rating Agency. So I focus on analyzing and rating banks.
Fantastic.
But I have 15 years on the buy side as an analyst and covered the industry through the global financial crisis.
Fantastic. Mr. Rose?
Oh, good morning, everyone. I am Dean Rose. I'm the Vice President of the Board of Education, so I am the board representative. Thank you all for being here this morning.
Great. Joey?
Hi, everyone. It's great to be with you. As mentioned, my name is Joey Mallon. I'm a member of Siegel Marco, specifically within the Manager Research Group, covering private credit and other what we call absolute return strategies, which are in the alternatives category.
Fantastic. And Derek?
Hi, I'm Derek Hoover Beat. I am assistant principal at Monocacy Middle School. I represent FACASA, our admin association, and I'm the vice president of that association.
Fantastic. And Missy? I know I've given you a little introduction, but I'll let you do your own too.
So I'll add on to that. While I am new to the OPEB Trust, I co-chair the county's insurance council. So been talking OPEB and liability and its impact for a long time, but this is a new facet of it for me.
Well, welcome. Tanya?
Good morning, everyone. My name is Tanya Keaty. I'm with Siegel Marco as a consultant and working with Christian on your plan. And nice to see you all this morning. I've been with Siegel Marco for just about 15 years now.
Fantastic. Megan?
Hi, good morning. My name is Megan Quinn. I'm a personnel officer in human resources for Frederick County Public Schools, and I am replacing my colleague Rob Bruno on the committee, and I'm excited to be a part with everyone. So thank you.
Great. And George?
Pasco, I'm a volunteer representative on the committee.
Fantastic. Thank you. And Renee?
Hello, I'm Renee Milburn. I am currently the restricted fund accountant with Frederick County Public Schools, and I represent the AMT group.
Great. And we do have a couple visitors or guests with us. Well, first, we have Catherine Rich with us. Catherine, you want to introduce yourself?
Catherine Rich, I'm the executive assistant to the Board of Education. I'm filling in for Lynn McKay, who's out on leave today.
Fantastic. And Shirley, I think I saw you earlier.
I'm Shirley McDonald. I'm a retired school teacher.
Fantastic. Thank you. And then we do have two guests with us today. Again, as I mentioned earlier, this is open to public, so anyone can join us. And we have us physical services geek that just love OPEB and love to join and listen in. First, I'll let Melissa introduce herself.
Hi, my name is Melissa Robinson.
Okay, Melissa, your volume was very, very low, but I think what you said is she's Melissa Rawson. She is our manager of financial reporting. This is her busy time of year, so I appreciate her joining in at this crazy busy time as she's putting to bed our FY23 and doing our annual report. And also we have with us is Heather.
Good morning. I'm Heather Clayball, the Director of Budget for Frederick County Public Schools.
Great. Well, thank you. I appreciate everybody's time this morning. So the first order of business is the approval of the May 19th meeting minutes. Does anyone have any corrections or anything on the minutes they want to quote about? If not, I'll entertain a motion for approval.
I motion to approve the May 19, 2023 OPEB Trust Fund Investment Committee meeting minutes.
Thank you, Derek. It's first. Second?
I'll second it.
Fantastic. Dean? Okay. All those in favor say aye.
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 Any nays? And any abstentions? Okay. So, Catherine, that is unanimous with all members attending. So I'm going to turn over the screen now to Tanya. She's going to go over the investment performance for the period ending June 30th of this year. And again, as I mentioned earlier, do not be shy. Ask questions if you have any questions as she goes along.
Okay, can you all see my screen now? Perfect. So as Leslie mentioned, we have the performance here through June 30th. Go through some market commentary pages first. You can see really the first half of this year has been very strong for equities. U.S. equities are leading the way. That's represented by the S&P 500, so up nearly 17% for the first 6 months of the year. International developed stocks, which is the EFI index, up about 11.7%, and emerging market stocks up about 5%. So really strong performance across the equity market. Some of the concerns around inflation have started to taper a little bit. Inflation is still high, but it's kind of tapering off. So companies have been performing really well. The jobs kind of data that we've seen, it has been favorable. Unemployment is kind of hovering around 3.7%. In terms of fixed income, it's been a little bit of a different story. I think the year started off really strong, and it's been a little bit more muted as of late. So, for example, the month of June, the U.S. aggregate index actually negative. For the quarter, slightly negative, and for the first 6 months of the year, slightly positive. So we've seen, kind of having that balanced portfolio that the plan has still really, really helped. I'll just talk to kind of the breakdown within the U.S. equity portion of the market in particular. It's been quite interesting to see, particularly IT stocks have been sort of leading the way. The IT sector up over 40% so far this year. So it's really some of those top names like Google and NVIDIA, Apple that have been driving the significant amount of the U.S. equity market performance. And you can see that here in terms of the difference between growth stocks and value stocks. Those tech stocks driving the growth performance up about 29% so far this year, and value up about 5%. So really a difference in terms of the performance, but we have a all cap sort of broad U.S. equity index strategy. And so we have exposure to all areas of the U.S. equity markets.
I'm sorry, Leslie, Tanya, I'm sorry to interrupt. Could we ask everybody if they're not speaking to put themselves on mute, because we're getting some background?
Yep, that's exactly why I unmuted. If we can all make sure we're muted as Tanya's giving her presentation, it really helps.
Thank you. You can see here.
You can see his screen lighting up. It's George.
Yeah, George, do you mind hitting you mute on your screen so we don't get the background noise?
Okay.
So in terms of the fixed income sector, the yield curve has continued to sort of rise at the shorter end of the curve, and you can see that here with the green bar. So that's the yield curve across fixed income as of June 30th. And with this kind of inverted shape here in the yield curve, what that means is that you're actually earning significantly more money holding cash or kind of real short-term bonds right now than you are looking out, over the 7 to 10 and, longer term time periods. And that, of course, has increased, as I said, since December, particularly on the shorter end of the yield curve. And then, of course, the Federal Reserve's rate hiking policy has been sort of a big topic. The Fed has now hiked rates again in May. They paused in June, but then again in July. So currently, short-term borrowing rates are at 5 to 5.25%, and that's exhibited here in the green bar. And you can see kind of rates were, basically at zero for a couple of years there throughout the COVID period, and then they started to raise interest rates over time to where we are today. There's been sort of talk about whether the Fed will stop raising rates at some point and whether they will actually begin cutting rates. Of course, we don't have the full crystal ball, but there is, I would say probably, I would expect probably 1 to 2 more increases this year. And then, in 2024, the expectation is that they will start actually cutting short-term borrowing rates. Those were my primary comments sort of on the markets. This chart here, I think, is interesting, especially as we later get into the discussion around asset allocation. This is what we call our sort of quilt chart. And each column here is a different calendar year historically, and each color represents a different index in the market. So different U.S. equity indexes, different international and fixed income, as well as cash, which is the 90-day Treasury bill, hedge funds, and real estate. And you can see here, kind of the purpose of this illustration is that over time, asset classes, there hasn't been really one clear-cut winner across asset classes. There really hasn't been one clear-cut loser. This chart, shows kind of how different asset classes all perform in varied ways over time, and really, I think, helps to make the case for diversification, because we really can't predict, how each asset class will perform in any given year. I'm going to jump into the plan performance, but let me pause and see if there's any questions first. Okay, I don't hear any. So here we put together sort of a summary executive summary of the plan, and I can talk through it, but everything that's written out here on this page will sort of be reflected within the report. But I will highlight here the last bullet that says the Fidelity Total Market Index Fund was funded in May. We liquidated the Vanguard Institutional Index, so that was an S&P 500 fund, and the Fidelity Extended Markets, which was the small and mid-cap portion of the U.S. equity markets. So we combined those into one Fidelity Total Market Index Fund, which is an all-cap fund. There's some fee savings there. So that happened. And then we have one fund on the watch list, which is Western Asset. They were added just about a year ago. Their performance has improved since we put them on watch list, but we're going to recommend that we keep them on the watch list for now, given the longer term trend of the performance. And since, later on this calendar year or this fiscal year, actually, we're planning to sort of go through a full review of the fixed income portfolio. And possibly make some changes there. So we thought it made sense to keep Western on watch list until that conversation happens later on. So this slide 15 here shows kind of your asset allocation policy right now. Currently, the targets are 55% in domestic or U.S. equity. Let me blow this up a little bit. 15% in international equity and 30% in fixed income. So this is your policy. This is where column here is where you are as of today, and you can see you're essentially exactly on target with your current policy. We do always have sort of these bands or ranges around your targets. So if you were to deviate up or down in either direction, you would not be sort of out of compliance with your investment guidelines. But you are, I would say, very close to target, which is not always necessarily where we'll be. We'll always try to keep you within those ranges, but no need or recommendation for any rebalancing specific to the current investment policy at this point. But we will be talking, of course, later on about moving, to a potentially different asset allocation policy.
And Tanya, I just want to mention to the committee members, in years past, what we've done is if we need to rebalance, we've normally done that when we make our deposits. So in years past, when we make a deposit, we reach out and say, okay, where should we deposit the money? Last several years, it's been in our fixed income because, of course, our equities have been performing well. Right. So we've been rebalancing. This year, our board in our budget, unfortunately, had to reduce or eliminate the OPEB contribution. So it's not there this year. So if we have to rebalance, we'll actually have to do a formal rebalancing between the equity between the different asset allocations to do so. So there, I've asked Siegel to keep a really close eye on that for us so that if we need to rebalance, we'll do so.
Great. Thanks for that color, Leslie. Here that we look at sort of the cash flow trends over time. And so the 1 year period here is your fiscal year. So I'll focus on that. There's been growth in assets overall of $20 million from 146 to 166 million. Cash flow, was positive for the fiscal year, 1.5 million, and then 18.5 million in investment earnings. So overall, that's a 13.1% return for your fiscal year, which I would say is very strong. Longer term history, looking out at the 3 years, there's been asset growth of about $40 million between the contributions and investment earnings. And in terms of a rate of return, that would annualize out to an 8% rate of return each of those 3 years. So the plan performance and sort of the underlying manager performance is here. And as I said, for the fiscal year, up 13.1%. Versus your policy benchmark, which is up 11.9%. So outperformance there. The longer term trend, I would say, is very strong with the 3, 5, 7, 10 years, and since inception, all in that 7.5% to 8.5% range. As I mentioned, we consolidated the equity portfolio this quarter. So we have the one investment now with the Fidelity Total Market Index. So 1 month of performance there, up 6.9% in line with the benchmark, as we would expect. Since the domestic equity portion as a whole has typically been in index funds, that performance over time generally trends pretty close with the benchmark there. And then Euro Pacific is your international equity manager. pretty good quarter. Fiscal year really strong. 3-year just slightly trailing the benchmark, and longer term similar. But overall, this is a manager that we have high conviction in, and we're possibly talking about adding a complementary manager to them later on during the year. But for right now, I'm comfortable with American Funds Euro Pacific as the international manager there. And then in the fixed income space, you have Dodge & Cox, who's kind of the core manager. Western Asset is a core plus mandate, so that's why the allocation there is a bit smaller. So kind of complementary to Dodge & Cox. As a whole, your fixed income portfolio this year so far up 3.2% versus the index up 2.1. Both managers are adding value over the aggregate index so far in 2023. Longer term numbers generally trending favorable as well, especially compared to your benchmark. So kind of that combination of the two managers has worked really nicely there. And then just a very small allocation to cash at $52,000 there. This has kind of trailing calendar years here. And then we have the trailing, fiscal years up top. When we talk about manager performance, I would say fiscal years is not really something we're as concerned with. But of course here, the plan year, fiscal year performance for your total fund as a whole, is something that's of course looked at, by the actuaries and for budgeting and all of that. So, generally I would say really strong kind of fiscal year trend at the top line there. Terms of fees, fees are very reasonable overall. I would say 22 basis points all in for your entire investment lineup is extremely reasonable. And then just sort of looking at some of the trends that we have with the cash flow here, looking at longer term history back to 2019, you can see here the asset growth, and this is just calendar year by calendar year opening value, any cash flows during the year on a net basis, the investment change, ending value, and then the return so far, or for the calendar year, and then for the last line, it's for the first 6 months of 23. So that's really all my comments on the investment performance, but let me pause there and ask if there are questions or thoughts.
So Tanya, you cover a lot more entities beyond just us. I'm just curious, how do you feel like we compared, this is what I think your second quarter with us. How do you think we compared against some of your others? And granted, everyone has a different allocation, whatever, but like if you had to rank your clients, where do you think we would kind of fit in?
I guess just in terms of what, is there a specific time period you're talking about?
For the quarter.
The quarter is actually pretty high, I would say, and that's I think because of what I would call fairly high equity allocation, which is something that we're going to talk about, bringing down to take some risk off the table when we talk about the asset allocation. But so pretty favorable.
Got it. Thank you.
You're welcome.
And yesterday I sent out the most recent asset allocation chart that shows where we've come down a little bit since June 30th. We tried to do this at each committee meeting because it's about a 45+ day lag between when they're reporting versus today. So as of the 15th of this month, we were just over 165 million in the fund. So it's got a little bit of a change, but if anyone's been watching the market, it's up and down and all over the place right now.
It has been. August has been pretty volatile so far.
Oh my gosh, yes. Every other day. So any other questions for Tanya? And I just realized I went off the script on the agenda, so I'm gonna have to backtrack. But any other questions here before I backtrack to the IPS, to the investment policy statement? Okay. Part of our package this month also was the investment policy statement, and we look at this periodically with our consultants to see if there's anything we need to change. There have been some minor recommended changes on here. Everyone hopefully had some chance to read that over. Tanya, we did find yesterday, Heather pointed out when she was reading, on page 4 under our investment selection, that last sentence in there is we need to rewrite it because it's obvious we must have edited it, and in it we really confused. The wording is way off. But basically what we want to say is that the investment consultant will work with the trustee and the committee members on any recommendations.
Okay. And just for Leslie, was it in the first paragraph or the
Yes, it is. It's the last sentence in that first
The
paragraph.
last sentence in the first paragraph. Okay. Yes, I see what you're referring to. Okay.
In our investment policy statement also, the appendix 1 is where it shows our asset allocation and what our targets are. So you can look at that and see the change. This is where we're adding that private credit, which we're going to talk about here with Joey in a few minutes. This just basically says we have the leeway in our investment policy statement to move into private credit. If you notice, the range is from 0 to 12.5. So it's not something we have to do. We can keep it at 0, or we can tip our toe in. And as you'll see, some of the recommendation is maybe that's what we do. We start gradually entering into that sector. So any questions on the IPS? Okay. If everyone's okay with this, what we do is we take this to our Board of Education. It goes in as a business item in the afternoon through their work session, and we ask for their approval. Because in theory, well, not in theory, in practice, the Board of Education is the ones that gives us, as the investment committee, the guardrails. So that's what the IPS is. It's the guardrails of what we have to work within when it comes to investing the funds within the OPEB trust. So I will work with board leadership and get this on probably a September board meeting. So I'll just let the committee members know so you can watch in case there's any questions or anything that come up. Okay, sorry about that, out of order, guys. So next, I'm gonna turn it over to Joey if there are no questions.
If it's helpful, maybe just before I turn it over to Joey, I know we have a couple of new committee members and we're talking about the allocation here. I might just want to show you this slide from our asset allocation review where we're actually kind of highlighting the mix that we're talking about moving to. And then hopefully that can give some context into the private credit discussion. So this is not really formally on the agenda, but just wanted to highlight this as part of the discussion. This is your current policy, which you know we went through when we looked at the report: 55% U.S. equity, 15% international, and 30% core fixed income. This is the mix that we're talking about, sort of moving to, and the mix that's actually in the updated investment policy statement. So that's the kind of the proposed interim mix. So we would be decreasing your equity allocation fairly significantly from 70% to 50%, increasing fixed income slightly to 32.5%, and then introducing 2 new asset classes actually, which is multi-asset class, which will, again, as Leslie mentioned, sort of the range there starts at 0%. So it's not something we're looking to necessarily move into immediately. And we're going to have some education sessions, you know, later in the year around that asset class, as well as private credit at 7.5%. And so the goal of this mix is to decrease your risk profile fairly significantly. When we looked at the portfolio initially, we thought that the risk, especially from the equity portion, was considerably high. And so the risk here, you can look at the standard deviation line coming down from 14% to 11.5%. So a significant decline there. Your expected return decreases slightly, but we're comfortable with that because we're actually, expected to get sort of where we're going more efficiently, and that the Sharpe ratio tells us that that's a measure of portfolio efficiency. So increasing that, pretty significantly from 0.33 to 0.37. So this is sort of the mix we're talking about moving to over time, and private credit is our first kind of foray that we wanted to, go into in terms of education because it is such a new asset class, for this group and for this this trust here. So hopefully that commentary is helpful before Joey jumps into sort of the private credit universe.
Yeah, I appreciate that. when I was talking to Christian and Tanya and Joey the other day, I asked them, I said, just the general basic question, why? Why would we want to do this? Why do we want to look at this, change in our asset allocation? And basically what we're looking to do is overall reduce the risk and the diversity of what we're investing in, but not affect our return all that much. So, and I just want to remind the team, in our actuary study that we do for the OPEB trust, we're using a 6.5% interest rate of return. So these rates are all still keeping us above that expected return.
Exactly. And the number I would focus on is this sort of long-term expected geometric return. And you can see here on a 10-year basis where it's a very minor change from 7.1 to 7 in our expectations. And on a 20-year basis, very minor from 6.8 to 6.7. So we're really, expecting you're going to get in that same return range while decreasing the risk of the overall portfolio pretty significantly. And you can see that here in the risk allocation. Right now, almost 100% of your risk is in that equity portfolio. So it's 70% of the portfolio, but 95.5% of the risk. And so we're going to be dialing that down pretty significantly by moving to a new asset mix. So let me pause there. Joey, would you prefer that I drive your presentation, or do you want to share your screen?
Yeah, sure. I mean, given that you're, already
Sure.
sharing, that
Okay.
that would be fine for me. I mean, I'd be happy to guide you along the way.
Perfect. All right.
Okay, great. Did you want to pull up the presentation here?
Sorry, I'm on the wrong document. I apologize.
No worries. No worries.
Private credit. There we go.
There you
Okay.
go. Alrighty. Well, assuming everybody can hear me okay, before I get started, please know that I'd really welcome any questions you have at any point. I'll be sure to pause periodically when moving from one slide to the next or one important topic to the next. So you may also ask questions then. There's quite a bit of information and content in this presentation, but I don't intend to read from the slides. They're really more so intended to serve as a useful tool for you all moving forward, to refer back to over time. But I will certainly acknowledge some of the key points on the slides. So with that, let's begin, as Tanya has here on slide 3, with a few bullet points that generally set the stage for our discussion in private credit. And let's really start with talking about what private credit is in the first place. In its simplest form, private credit is an investable asset class that involves investment managers making loans to private companies, primarily in the United States. That is really private credit in its simplest form. Again, managers making loans to private companies in the United States. Private credit is somewhat comparable to the investments of the plan within the fixed income category, although the investments in fixed income so far with Dodge & Cox and Western Asset to date have been focused primarily on publicly available securities, primarily government bonds and corporate bonds. And so the drastic distinction is that public to private universe. It's an entirely separate set of private companies that are not listed on public markets. As we dive deeper into the rabbit hole of private credit, you'll find that there are many investment strategies that may ultimately be categorized as private credit. We'll become more familiar with those over time. However, in the first phase of our journey, we'll keep it simple and really focus on investment managers that primarily make loans to private companies. The bullet points on this slide highlight several features and characteristics of private credit, but I won't reference them here. We'll get into those a bit further along in the presentation. Moving to slide 4, the graphic here presents the entire credit universe, both public credit and private credit. What you're seeing in the blue boxes are various areas of the investable credit markets, spanning from the lowest risk and return on the left-hand side to the highest risk and return on the right-hand side. One thing I would point out here is that we're really showing these strategy types on a comparable basis. And so I just want to be clear in saying that even on the left-hand side of the screen, these investments don't come without, taking on incremental risk. High yield and bank loans, just calling those out as examples, while they are public credit strategies, they are certainly more risky, if you will, than the core investment grade current allocations that you have within fixed income. So I just want to call that out specifically. But importantly, this is intended to give you a general representation and a general sense of the credit markets. And it's, of course, subject to change over time as the market environment and the world around us, of course, changes. The key takeaway that I'll point to here is the concept that there is a trade-off between risk and return. The higher the risk, generally the higher potential return. And bringing this back to private credit, at the top of the middle blue box, you'll see the term direct lending. To many institutions such as yourselves, the term direct lending is really synonymous with the term private credit. We'll get into the concept a bit further with respect to direct lending later in the presentation, but I call it out here to make the point that direct lending is really somewhere in the middle in that continuum of risk and return. The investments that your plan has within fixed income with Dodge & Cox and Western Asset, if they were to appear on this slide, they would certainly be on the left-hand side as they are generally conservative investment strategies. Moving to slide 5, the graphics shown here show the typical capital structure of a corporation across repayment priority on the left and risk on the right. Beginning with repayment priority on the left, you'll see that senior debt and subordinated debt, which is really a fancy way of saying junior debt, appear toward the top, while equity investments sit at the bottom. Most often, the loans or investments that are made by private credit investment managers sit in either of the senior debt or the junior debt categories. Our typical preference certainly has been to emphasize investment managers that focus on the senior debt category, as those investments they make are at the top of the capital structure and are really first in line to be repaid by the corporate borrower. As you'll see on the right-hand side of the screen here, in which we show risk, the graphic is really turned upside down. Investments in senior debt are the lowest risk, sitting at the bottom, while equity investments are the highest risk. The key takeaway here is that junior debt is really, again, somewhere in the middle and remains constant across both the left and right-hand sides, while senior debt and equity really are inverted in both sides. The next slide dives into this concept a bit further. In the interest of time, of course, I won't go through every box on the screen, although I'd encourage you, again, to use this slide as a reference tool or a reminder in the future. Beginning on the left-hand side, going from top to bottom, the rows titled Security and Priority of Payment, and as well as Typical Target Return, speaks to the concepts that we covered on the prior slide. Senior debt, again, sits at the top and is most senior in the capital structure, while equity is at the bottom and is most junior in the capital structure. Again, there is a trade-off between risk and return, and junior debt is in the middle. We could spend, admittedly, all day on this slide alone, but I think the key takeaway here is really in the rows titled Typical Covenants and Typical Coupon, which are really in the middle of the table along the left-hand side. In private credit, investment managers that focus on senior debt and junior debt investments, certainly in today's market, are in the driver's seat as it relates to negotiations. This is particularly true with respects to the row that is titled Typical Covenants. Just taking a step back for a moment, a debt covenant, just so you know, is a condition, or rather a formal agreement that is put in place by lenders, which ultimately limits the borrower's actions, or the actions that the borrower is allowed to do. There are several types of covenants, but in general, there are covenant protections that require borrowers to perform certain actions. There are other covenants that limit the borrower's abilities to perform certain actions without seeking approval from the lenders. And there are others that are really numerically tied to monitor performance and the health of the underlying borrower. In today's market, senior debt is typically, the loan agreements that are being made have full covenant protections in place, where junior debt typically has some, but not as many covenant protections as you would see in your typical senior debt investment. Equity investments, on the other hand, typically have no covenant protections. And so equity holders are really subject to the risks of the underlying corporation and have very limited control in terms of what they are able to do if they were to ever need to defend their position and their value in the company. The managers that we would advise you to consider and focus on are really principally focused in the senior debt category and are thus in a position to negotiate various types of protections in the loans that they offer to the companies that they ultimately lend to. With respect to the typical coupon row, the vast majority, if not all, of senior debt investments are floating rate loans. Now, that term floating rate is something that you'll hear from many managers in the private credit category if this is of interest to you moving forward. What floating rate loans really means is that the interest rates embedded in the loans rise and fall as the interest rates that are set by the Federal Reserve rise and fall. Interest rates are often synonymous with the term coupon rate. As you've likely heard or experienced over much of the last year, interest rates have been rising, and that was something that Tanya pointed to earlier in the presentation today. And that's particularly true in the US, as the Federal Reserve has really raised interest rates in an effort to better control inflation, or at least get inflation to be a bit more under control. As a result of rising interest rates and a few other factors that we could point to, the return potential of senior debt investments has materially expanded over particularly the last 12 to 18 months, given that as interest rates have increased steadily as a result of Federal Reserve actions, the loans that are made using that Federal Reserve reference rate have also risen as a result. So they have certainly benefited in that regard. You'll see there that in the row just below that, where we say typical target return, senior debt today is generally offering about a 10 to 12% return, and that is on a unlevered basis, which I'll get to that term unlevered a bit further in the presentation. And of course, as you take on more risk, moving out to the right in each of the respective columns, of course, the return potential expands as well. Junior debt investments, importantly, feature what is called a fixed interest rate. And as the name implies, the fixed rate benefits less directly from the rise in interest rates over the last year. However, junior debt investments are typically priced relative to senior debt investments. And so what you'll see is that as you move to the column titled junior debt, they offer a slightly higher typical target return. In today's market environment, they are ranging generally between 12 and 14%. And so they too have also experienced a rise, particularly over the last year or so. Now, let me pause there. I realize I've only gotten into really the early innings of the presentation, but we've covered a lot of content already, a lot of important content. So let me pause to see if there are any questions on anything I might have mentioned so far.
So Joey, you used the term senior debt or senior position. Do you know for like direct lending, are there also like unitranche deals, or is it truly like true senior?
That is a great question. So you are spot on. There are some investment managers within direct lending that do pursue unitranche deals. And just for the broader audience, what a unitranche investment is essentially taking the senior debt portion and the junior debt portion and really merging them into one category of investment. And so these investments, generally speaking, relative to a typical senior debt investment, are viewed as being slightly higher risk, given that the exposure a manager is taking on to a single corporation is a bit larger, including the junior debt category. To your question on unitranche, I think it's a great one because those types of investments have actually been becoming more popular, especially in today's markets. But I think it's important to note that the managers we would advise you to consider in the early innings of your private credit journey actually avoid unitranche, or at least that is a very small portion of their overall investment strategy.
Got it. Thanks.
Any other questions before I move ahead? Okay, great. Hearing none, now that we've covered some of the fundamentals, as Tanya flipped forward here, we'll move to slide 7 and really begin to connect some of those fundamental dots, if you will, to actual private credit investment strategies. As you'll recall from earlier in the presentation, I mentioned that term, direct lending. And direct lending, just so you know, is profiled here on the very rightmost column on the very far right-hand side of the screen. The first 3 columns present investment strategies that are really focused on the public markets, whereas again, direct lending is really focused on the private markets. We offer that comparison really to offer you a comparison of what is available in the public markets and to offer a relative comparison to what is currently in your investment portfolio. Your investments with Dodge & Cox, just to be clear, I would really categorize them in that first column that you see there that is titled investment grade, again, being fairly conservative strategies overall. As a reminder, direct lending strategies focus primarily on making senior loans to private companies. And on this page, again, we compare that category relative to some of the publicly available investment opportunities. Again, there are several distinctions I could make between investment grade and direct lending. But in my opinion, some of the most important distinctions are, first and foremost, that direct lending is typically focused on floating rate investments, whereas investment grade is typically focused on fixed rate investments. And so again, direct lending benefits as interest rates rise and fall, whereas investment grade, your rate is kind of fixed, from the moment of your investment forward, and it's really disconnected from the overall actions of the Federal Reserve. Second, direct lending investments are typically secured and senior investments, whereas investment grade is typically unsecured and sits junior to those other senior debt investments. Third, direct lending investments in today's market typically feature a whole host of covenant protections, as we covered on one of the prior slides, in investment grade, those typical covenant protections are really not in place, given that the overall negotiation process is typically driven by a traditional bank, and the process is much more straightforward and really does not feature a very in-depth negotiation process as you would see on the direct lending side. Importantly, direct lending strategies are typically levered investments. You may recall I mentioned that term unlevered, but most typically direct lending investments are levered, whereas investment grade strategies are unlevered. To be clear, using leverage, which is where that term comes from, leverage is the act of borrowing money for the purposes of making investments. And what leverage ultimately does is it increases both the return potential of the investment you are making, but it also does increase the overall risk profile of the investment as well. And so we offer that comment here really to make the point that in certain direct lending strategies, there can be some material risk. Importantly, again, in this initial phase of your private credit journey, the strategies that would advise you to consider are unlevered. And so to be clear, they do not borrow money for the purposes of making investments, and thus their risk profile overall is much more controlled, or at least narrower in the grand scope of the strategies that are available in the private credit category. Companies pursued by direct lending strategies are often smaller companies than those that you would see in the investment grade category. In the investment grade category, those would really be companies that you know and hear of and likely use in some way every day. You know, the Apples of the world, the JP Morgan Chases of the world, really large scale companies that issue investment grade bonds. In the direct lending category, they're much more founder-owned businesses, much smaller scale, and you may know some of them, of course, just based on your activities in life. But generally speaking, many of the companies that even I come across in the private credit category, I have not heard of before, and they are typically smaller scale, founder-owned, really mom and pop types of shops. I would generally say in a casual way. And the last item I would point you to here on this slide is the row titled liquidity, which appears second from the bottom. And this is an important one, as private credit and direct lending more specifically is an illiquid asset class, meaning that the investments are typically locked up for an extended period of time. As you see in the box within direct lending, it's typically within the range of 5 to 8 years. I will tell you candidly, most typically we see investments up to 8 years. That 8-year general life span is pretty typical in the private credit category. And the fixed income strategies in your plan, to be clear, those that you've pursued to date, are really liquid investments. They would fall as being daily, publicly traded types of strategies, meaning that the money that is invested in those strategies is really available, readily, quickly, subject to a day or two notice, to the underlying manager, of course. That difference in the availability of funds that are ultimately invested is a meaningful factor that drives the difference in the return profile that you see across some of the public strategies and the private category that you see on the far right-hand side of the screen. So now that we've covered all of that content, moving forward to the next slide, as a result of that illiquid profile that we just discussed in the direct lending category, the strategies, within the private credit category use a different legal structure to operate. To be clear, as you've heard me mention a few moments ago, private credit strategies typically have a lifespan of 5 to 10 years, right? And most typically a life of 8 years. This is in stark contrast to some of the investments in your plan today, as those investments currently are perpetual life investments, meaning that the investment structure, say of a Dodge & Cox and a Western Asset, those investment structures do not have a specific end date, right? Private credit strategies, not only do they have an end date, but they also have a start date, right? And so there is a defined life of these investments, typically, again, over a 5 to 10 year investment horizon. The way a private credit investment structure works is typically in 4 stages, as you see profiled along the bottom of this slide. The first phase, which is actually not profiled on this screen, is really what we call generally the fundraising period. During the fundraising period, investment managers go out to institutional investors such as yourselves and ultimately market their capabilities. They do so in hopes that investors such as yourselves will commit capital to their private credit strategy, ultimately the one that they're seeking to offer. And fundraising periods typically last about a year or so. In your walks of life, you may have heard the term roadshow, but that is generally synonymous with the fundraising period. It's the period during which the investment manager approaches investors such as yourselves, again, and markets their capabilities in hopes that you will commit capital to their strategy. The next phase, which is the first phase that appears on the slide, is the investment stage. And the investment stage typically lasts 1 to 5 years, depending on the underlying strategy, with an average investment period of roughly 3 years. I will tell you for direct lending strategies, the investment period is typically 3 to 4 years, with 3 years being the stated number, subject to about 1 year of potential extension at the discretion of the investment manager. During this time, the investment stage, the investment manager programmatically issues what are known as capital calls to investors such as yourselves that may have committed capital to their investment strategy. Capital calls typically represent about 5 to 10% of the committed capital that an institutional investor has promised to the investment strategy. And to be clear, capital calls are represented in the graphic at the top of the page by the dark blue bars that are below the lightly identified black line. And again, to be clear, that represents money that is going from your plan to the investment strategy that the investment manager is offering. And so in simple terms, the manager slowly calls the capital that you all may have committed to their investment strategy over roughly a 3 to 4 year period. The next stage of this life cycle is the development and the harvest stage, during which the investments made by the manager mature. As those investments mature, the investment manager typically steadily receives money from those investments by way of coupon payments in the loans themselves, as well as, at times early repayments, among other methods of repayment from borrowers to the investment manager. As those investment managers accumulate that capital, they ultimately return them to their investors through capital distributions. Capital distributions are represented by the green bars that you see above the lightly colored black line. And that represents money that is going from the investment manager back to a plan, such as your plan. The last phase of the is the liquidation stage. As its name implies, it's the period that occurs last and is during which the investment manager is really working to wind down their investment offering. Their investments have largely matured, but there may be a few, a small handful of last remaining investments that they are working to realize and conclude. And it's really the last couple of years of the investment life cycle, again, during which the manager is working to close down their investment offering. The red line that you see on the graphic is really simply to show you the general profile of the cash flows throughout the life of a private credit investment, which ultimately drive the rate of return that you all receive over time. The shape of the red line is often referred to as the J curve. That's another term you'll hear frequently in the private credit category. And it really means that the shape of that red line really looks like the letter J. There's really no better way to put it. And so it's called the J curve. But generally in the early years of the investments, returns are either close to zero or perhaps slightly negative, as the investment manager typically takes about a year or two to invest a meaningful amount of the capital commitment that you all may make to a private credit strategy. However, returns typically accelerate beginning in about year 2 or 3 of the investment, as a material amount of capital has been invested by that time and is income producing, through the fact that these are loan agreements that managers are committing to. And so capital ultimately begins being returned to investors such as yourselves. And so that general shape that you see there represented by the red line is, of course, just for illustrative purposes, but it gives you a good sense of what your return profile would be in some of these private credit strategies that we're discussing today. So again, I know in just the last couple of slides since I last paused for questions, we covered, again, quite a bit of content. So let me pause there to see if there are any questions on the mechanics or perhaps some of the other strategic points that I mentioned on the prior slide.
Joey, when these investment managers are going out and doing these lendings, are they normally industry specific or sector specific, or do they also diversify within their portfolios?
That is a great question. So I will tell you, most managers, the real answer is that most managers have areas of expertise, right? There are certain industry sectors where, perhaps they have a history, or perhaps analysts on their team, have a history covering. And so perhaps those are the areas they may focus on most. But what I will tell you is the strategies we would advise you to consider in this early phase of your private credit journey are really diversified across sectors. This early, it is rare that we would, advise you, say, to focus on a fund that only targets technology or technology-related companies, right? In narrowing into one sector, ultimately that causes the strategy to have a bit more embedded risk, and that really is not the profile that we, would advise, again, in the early stage of your private credit journey. We would advise a more broadly diversified profile. The one thing I would say, to your point, it's not directly to your question, but I think is related, is geographic diversification. The one thing I would say is that the private credit universe is really most robust in the United States. I would also say, as an honorable mention, the European market is actually quite sophisticated as well. So those two areas, North America and Europe, principally Western Europe, are the areas we would advise you to consider in the early stages. Admittedly, the private credit universe in Asia or the Asia Pacific region more broadly, or in the emerging markets like Africa or South America, are really just not that robust. And there's, as you move into those nations, there are other risks like jurisdiction risk, legal risk, currency risk, for example, and those are just not risks we would advise you to take on at this stage. And so most of the strategies that we would be discussing with you in the early stages are really either US focused or, call it 70% US, 30% Europe. That's typically, the profile that we would see. So while it's not directly related to your question, I do think it just speaks to the broader, sense of diversification.
I appreciate that information. Great.
Sure. Any other questions
Joey,
before I move on?
I have another question. I'm probably getting ahead of myself because I think later you have slides on the managers and things like that. So you can tell me to bottle it, and I'll hold it for later if it's a better time. But as I look at the three asset managers or investment managers you're suggesting or talking about or will talk about, are they doing, and I'll just stick with my kind of direct lending example. So are they doing the direct lending negotiations and everything and doing the contracts with the actual borrowers, or are they using, and again, in a direct lending world, like a BDC to kind of, so are they direct to the end borrower, or are they using a BDC as a conduit where they're maybe investing in the BDC, or they're just buying the debt that the BDCs are issuing? I'm just curious how direct is direct.
Yeah, that's a phenomenal question. Quite detailed, honestly. I will tell you the managers that you see profiled on slide 16, they are engaging directly with the underlying corporate borrowers. To be clear, to use your term, BDC, and for the broader audience, BDCs are actually publicly available investment vehicles that ultimately attempt to provide a exposure to the private credit universe. Given that they are publicly traded, though, at times there can be some disconnected volatility that results as a result of the fact that them being traded vehicles. And as our colleague here mentioned, they do at times offer debt structures that allow you access into those BDCs. But to be clear, the strategies that we are profiling here, they engage directly with corporate borrowers. They do not use BDCs as a conduit, exposure ultimately to the private credit universe.
Thank you. Sorry to jump ahead.
Sure. No, it's a great question. But assuming there are no other questions, maybe I could just flip us back to slide 12, and I will begin to move a bit more quickly here. You would notice I actually skipped a slide. I skipped slide 11. Slide 11 really just for general reference, it really provides bullet points that summarize many of the things I've mentioned so far. So I would point you to slide 11, or rather, I apologize, slide 10 as the kind of reference tool for you as you move forward in your journey here. But Tanya, now if you would move to slide 11, apologies for the confusion there. Much of the content that you see here really is aimed to provide a bit more information on the types of investments that are ultimately made by direct lending managers. And what you'll see here, and the key takeaway, is the difference between sponsored and non-sponsored lending. Again, these are fancy terms that for some reason we use in the finance world, but sponsored companies are companies that are private and owned by private equity. You may have heard the term private equity, at some point in your lives, but private equity are investment managers that own private companies, and as the name implies, they do so through the equity category. But sponsored companies, again, are private equity owned. Non-sponsored companies are companies that are private, but instead independently owned, typically by a management team or a small group of founders, or perhaps a singular founder or operator of the business. The key takeaway here is that sponsored companies are typically viewed as being less risky, given that they are professionally managed, and they also have the investment capital of the private equity firm really serving to bolster, their ongoing operations and to provide them capital, in the event of stress. As a result, loans to sponsored backed companies typically offer a slightly lower return profile than loans that are made to non-sponsored companies, where you're really reliant on either the management team or the founder to get it right, to professionally manage the business. And in simple terms, oftentimes the pockets of founders and operators aren't as deep as the pockets of private equity firms. And so there's a bit more risk as it relates to, the ongoing ability for that company to be a going concern, moving forward. And so there's, for those risks, there's slightly higher return that is offered in the non-sponsored universe. Moving to slide 12. Again, here we provide, some high-level information about the target universe of direct lending. But in short, companies that are pursued by the majority of direct lending strategies are typically categorized as middle market companies. Again, that's a fancy term we use in finance that ultimately translates to medium-sized companies, right? They're not small, they're not large, they're somewhere in the middle. And as you can see in the middle market, it can be broken down again into two subsegments, the lower middle market on the left, the upper middle market on the right. And the most common definition that investment managers use is earnings, right, which is the top row that you see in the table here, or EBITDA, which is an accounting term that stands for earnings before interest, taxes, depreciation, and amortization. But ultimately, EBITDA translates to the ongoing earnings profile of the underlying corporate borrower. The strategies, to be clear, that we would advise you to consider in the early phase of your private credit journey are middle market focused. The middle market universe is the largest universe of companies. There are multiple thousands of companies, in the United States alone that qualify as middle market companies. And again, these are companies that you would see on Main Street, right? They are, again, either management led or founder led, or perhaps owned by a private equity firm, but are still, fairly small scale, certainly relative to, the names you hear like Apple or Google. They're certainly much, much smaller than that. Moving to slide 14 in the interest of time. Here we profile what is called opportunistic credit. Just to be clear, credit sits within the broader umbrella of private credit. It is another type of strategy, as is the case, with direct lending. And within opportunistic credit, there are even, more sub-segments that we could point to. The matrix that you see at the bottom really is just intended to give you a general sense at a high level of other strategy types that are available within the private credit category. The interesting thing I would say here is that as you see on the target gross return or IRR profile that you see on the right-hand side, there is really a range or a spectrum of opportunity within the private credit category. Again, the strategies that we would advise you to consider, in the early phase of your journey are in that bottom rung that you see across the matrix. They're really strategies that target performing businesses, that really aren't in any situational stress or distress for that matter. That really is really something that comes later in the life of your private credit profile. And so we offer them here really to give you a general sense of what is available. But again, the general focus that we would advise for you in the early innings is really in the direct lending category. So I won't spend, too much time here. Moving forward, as our colleague pointed to earlier on slide 16, we show a few manager profiles. And I won't dive deeply again, just in the interest of time, but to generally summarize, the category that you see, or first of all, the three managers that we would advise you to consider, at this stage are Hamilton Lane, which is a Philadelphia-based manager, Sigler Guff, which is a New York-based manager, and BC Partners, which is also a New York City-based manager. Each of them, as you can see, they offer three distinct strategies, which, as you can see in that upper, most gray row, they kind of have similar names, which doesn't make our lives any easier. And as if we were to add more columns, you would see that the names are actually fairly similar across other managers as well. So it makes things a bit problematic. But ultimately, these are three distinct strategies that operate, over their own distinct lives, right? Just to generally summarize, Hamilton Lane and Sigler Guff, I really think you could think of them as really fairly similar strategies and think of them side by side. Again, they are direct lending strategies. They target, for Hamilton Lane, about 70% of their underlying exposure is in the senior debt category. So it emphasizes, senior debt. The balance, about 30%, is really more so focused on that junior debt category. There are a few other investment structures that they pursue as well, but ultimately, I think you can generally think of them as being junior debt. And so the profile, again, is about 70% senior debt, 30% junior debt. And for Hamilton Lane, all of their investment activity is centered in private companies that operate in the United States. In the case of Sigler Guff, I would really characterize the profile as being a bit more balanced. About 50% of their investment exposure is senior debt. About 50% of the debt exposure is in junior debt. Again, there are a few other investment types that they pursue as well. But I would generally say you could think of it as a balanced profile, 50% senior debt, 50% junior debt. And again, the entirety of their investment appetite is in the United States. As a result of that similar profile, if you look on this table sort of in the middle, you'll see that we offer target return and target cash yield. Hamilton Lane, just starting there, their target return is about a 10% net ongoing rate of return. Sigler Guff, given that they're taking on a bit more junior risk exposure relative to Hamilton Lane, it offers a slightly higher return profile, right? So that's why you see that it's a 12% net ongoing rate of return. The point I'll call out in the cash yield row is that both of these strategies actually offer an ongoing distribution of income once you are invested. Typically, that distribution takes place quarterly and starts at about year 3 of the investment lifespan of these funds. Once the managers have invested a meaningful amount of capital, those loans ultimately kick off an ongoing income profile, and that income isn't held by the managers. That is distributed back to you. Typically, that distribution profile on an annual basis is somewhere in the range of 6 to 8% or so, and so it's meaningful. It's a meaningful amount of income that is being produced by these strategies. Moving a bit lower in the table here, in the liquidity rows, you'll note that Hamilton Lane has a 1-year investment period. And so they ultimately deploy capital, they invest capital very quickly over a 12-month cycle, whereas Sigler Guff has a bit longer of a runway for their investment activity. It's a 3-year profile. So again, a bit longer and allows them some flexibility to adjust their investment appetite as the market environment around them changes, over time. The term, as you see there, just one row lower. For Hamilton Lane, it's a 5-year fund term. And so they invest over 1 year, and then they use the balance, that 4-year period, to ultimately go about, harvesting the loans that they have made. And slowly over time, they wind down their exposure over a 4-year period. Again, Sigler Guff is a bit longer of a fund, but again, you see that magic number of 8 years, right? So their fund life is 8 years, a 3-year investment period, followed by a 5-year wind down on the back end. We'll get to fees in a moment, but I actually think it's likely helpful that I profile BC Partners before getting into fees. BC Partners is relative to certainly Hamilton Lane and Sigler Guff. It's a bit more flexible of a strategy. It still targets senior debt principally, but the senior debt exposure is ultimately about 60% of the fund's overall exposure. And in the balance, that 40% or so, there are a number of investment types that BC Partners can pursue. I would generally say that if you think of the 40% or so that's remaining, about another 20% is junior debt exposure. And then the balance, about 20% or so, is a bit more flexible. At times, BC Partners may take on specialty types of investments that may be generally categorized as asset-based loans, or perhaps making a loan that is secured by the accounts receivable of a company, right? So providing more so working capital to that underlying company. But generally speaking, while there are many investment types that qualify within this BC Partner strategy, they are generally related to corporate entities in some way, shape, or form. And so generally, we think of BC Partners as being quite similar to the direct lending category, but does offer a bit more flexibility. And so as a result, you see that their target return profile is a bit higher in the 12 to 15% net of fees range. They offer as well an ongoing income profile that is in the mid to high single digits. And similar to Sigler Guff, they operate with a 3-year investment period and an 8-year total term. So again, very similar in terms of the illiquidity profile of those funds. Moving to the last section here before I pause and conclude and take any last questions that there may be. You'll see that each of these funds has a distinct minimum investment threshold. One thing I will tell you is we at Siegel Marco, that is, have a very good relationship with each of these managers. And so those minimum investment thresholds are very flexible. We have actually invested as low as $250,000 or I should say some of our clients have invested as low as 250,000 with some of these managers. And so those are the stated numbers, if you will, but there is flexibility if you have appetite, to pursue any of these managers at a scale that is lower than that number. But most important in this last section is the point around management fees. You'll note that Hamilton Lane is the lowest fee manager at about 90 basis points on net invested capital. So importantly, each of these managers is only charging you money on the money that is actually invested, not on the capital commitment that you're making. Say you make a $10 million commitment, for example. As that capital is pulled steadily by the manager over time through capital calls, the amount of money that they've called through capital calls is the only amount of money that you're being charged management fees on. There are other managers that charge on the full capital commitment from day one. And we typically don't advise investments in those types of funds because we just don't think that management fee profile really makes sense for the end investor. So importantly, each of these managers only charges management fees on the money that is actually invested in the ground. Hamilton Lane is the lowest fee at 90 basis points. And then you'll see Sigler Guff and BC Partners both are a bit more expensive at 1.5% in both cases. Each of these managers also participates in the gains that they ultimately generate. Hamilton Lane, you'll note again, is the lowest fee. Hamilton Lane participates in 10% of the gains that they generate. Sigler Guff participates in 15% of the gains they generate, and BC Partners, again, 20% of the gains they generate. But importantly, that is subject to a minimum investment return. And so in the case of Hamilton Lane, that is 6%, Sigler Guff 8%, and BC Partners, again, 6%. What I will tell you, generally speaking, is the management fee and incentive fee profiles that you see here, as well as the hurdle rates for that matter, that minimum return threshold, is really squarely with what we would typically see in the private credit category. And the one thing I'll note is that Hamilton Lane is actually quite a cost effective strategy. That is basically the lowest fee that I've ever come across in the private credit category. And so many clients like yourselves have of course, looked favorably on that fee profile. But I'll pause there. I know I covered a lot of content and I covered it in a very short amount of time. I appreciate you sticking with me so far to the extent you have. Hopefully I didn't lose you along the way. But given that this is the last slide, before we get into the appendix, let me pause to see if there are any questions on the managers, any questions on the asset class, or perhaps the direct lending strategy that I covered. Great. Well, hearing none, perhaps Tanya, I'll pass the baton over to you. Would you like me to cover this slide, Tanya? Just while we have a few minutes.
I don't know if we have to. I don't know that. I think it's just kind of in there for conversation. But I mean, since we're kind of coming up around the top of the hour, I don't know if Leslie, if we want to sort of tie into what we were thinking about for the next meeting. Our original kind of plan when we talked about kind of a schedule for action or for consideration, for this group is to, have the introduction and education on private credit today, the initial education. And thank you, Joey, for leading us through that. I know that was a lot of content. I appreciate you walking us through all of it. So our thoughts were, if the committee is interested in continuing to explore further, that at the November meeting, we would bring in either one or two of those private credit managers that Joey just talked about. And so that way you can kind of hear the story directly from them, get a more kind of, on the ground feel of what exactly these managers are doing. And if we're comfortable making a recommendation to potentially move forward with one of them.
And I know originally we had talked about it in November, also doing a presentation on another international equity manager. I'm not sure if that might be a little much for one meeting to have both. So the committee's okay, I think we'll stick with just talking with one or two managers from the private credit world to get a feel for that in November.
Agreed. I think we should kind of stick with the one topic and not try to put too much on the agenda for November.
Right. Okay. George, I have to ask you if you can hit mute again and we can hear your doggy.
Oh, okay. Well, I did have a question as I was trying to get to it. Hey,
Go
George,
ahead.
go back a couple slides. When you look at those fees, those are, pretty significantly high. And kind of the recommendation is to move out of equity, and to a much higher fee asset. The risk reward, I don't know if it's that much different. What's the bottom line for moving some of the funds from the reasoning from equities to some to private credit? What's the advantages?
Sure. Well, there are many I could point to, but maybe I'll just start with fees for a moment. I think it's important to note, as it relates to the target return row that you see on the slide here, all of those return profiles that you see are net of fees. And so that is certainly embedded as part of the overall consideration. You, George, are spot on. I will tell you that to a new entrant in the alternative space generally, I will tell you that fees in alternative strategies tend to be, much higher, generally speaking, than in the equity or fixed income category. But really, the difference in fee, I would principally say, is really related to the underlying, the time and, of course, the platforms that it takes to operate some of these the private credit strategies that you see here. The underlying teams that these managers have are really quite robust. In some of the cases, these managers have over 100 investment professionals that are dedicated to these strategies. And so the, investment professionals themselves, the overall systems and functionality that they use, all of that is very costly on an ongoing basis, as opposed, say, to, an equity strategy, for example, that is, simply investing in, say, the S&P 500 or the U.S. equity market, generally speaking, through a easily accessible, investment vehicle. The deals that are ultimately pursued by these managers are very unique, very different, and ultimately, as a result of that, there is a premium to be paid, as it relates to management fees and incentive fees. The one thing I would say, perhaps to the other part of your question, which really relates to the risk and return profile of these strategies, I would tell you that these strategies historically have actually exhibited a volatility profile or a standard deviation that is lower than the equity markets, broadly speaking. Most managers in the private credit category, as you think of standard deviation, they typically offer about a 6 to 8% standard deviation. In some strategies, just to be clear, in private credit, some of them can be very risky, but the ones that we're presenting to you here today overall are fairly conservative on an ongoing basis. And so tying it back to Tanya's point that was made earlier with respect to the overall asset allocation, we have seen clients such as yourselves adopt these strategies really in an effort to bring down their overall volatility profile and standard deviation profile, while not exactly sacrificing return to ultimately achieve, that objective. And so, George, I offer that as kind of high level points to the heart of your question. But admittedly, it's a great question, and certainly we could spend much more time on it if you would, love to do so. I would be happy to talk to you about it a bit further, but it's the conversation of risk return and how that relates to fees. Ultimately, we could spend the whole day on a topic like that.
Yeah.
But George, hopefully that was helpful. I hope so, but if not, please feel free to let me know.
We're good for now.
So as I mentioned, for November, we will have some private credit managers come in and talk to us and continue this conversation. In the meantime, I do want to remind you about the trainings. Everybody can attend if they'd like. There's the fiduciary training and then the investment trainings that we'll be setting up probably in October. Also, before the next meeting, we will be presenting a report to our Board of Education, on the biannual actuarial report. Even though this committee is really simply focused on what's the investments of the OPEB trust, the bigger discussion of OPEB is what is your liabilities? Where do you want to be? When do you plan to tap into this trust? Those kind of discussions. And that is going to be in a report going to our board in November also. So that is coming forth. And then last but not least, if you have not heard, November will be my last meeting with the OPEB Trust. I will be retiring January 1. And so it is bittersweet because my first day at Frederick County Public Schools, my first task that I got was to set up the OPEB Trust. So I started, and I remember on June 30th, 2008, making the initial deposit. The county actually made it for us, but the actual deposit that went into our trust back in 2008. So it has been great to watch this trust grow over the years and go from an infancy to what we say is advanced adolescent stage at this point in our trust. So I'll be exiting out of OPEB at that time. So any questions before we adjourn today? All righty. Well, I thank Joey and Tanya very, very much for the presentations. A lot of information, very well explained, and appreciate it. And we're looking forward to that conversation continuing at our November meeting.
Great.
Thank
Thank you all for your time. It was very nice to see you all again.
To Derek, good luck on your first week of school.
Thank you.
All right. Take care, everyone.
Bye.
Bye.
Bye, everyone. Take care.